This conference will now be recorded.
It looks like we have a couple callers. Okay. Can you still see my screen?
Yes.
Perfect. So I'm going to go ahead and just get started, and if people come into the chat, then that's fine. So hello, people who are with us. My name is Shara. I think everyone who's on this call actually is familiar with the TMA team, myself and Melissa. This is our September executive talk featuring fractional CFOs, and we're lucky to have James Wheeler and Jeff Cummings with us today. So I'm going to go through my slides quite quickly. Just an introduction. We do an executive talk every month. This month features James and Jeff. Next month we will have the California Manufacturing Technology Consulting firm with us, and we also have a BlueTech Global Connect webinar that we do each month. In October, it will feature aquaculture and biomarine companies. We have 3 international companies that present to an audience around the globe, and both of those will be taking place on October 22nd and Friday, October 16th. I also need to mention BlueTech Week, which is now in full swing. Our registration is open, and it's kind of an all-hands-on-deck situation for the TMA team. Each week we're confirming new speakers, and we're really excited for this year because it will be virtual for the first time. So those who are interested in speaking opportunities, if you haven't gotten in touch with us already, we have a full schedule of panels and topics and speakers. So you'll be hearing from us, or please do get in touch if you'd like any further information about this year's event. And here's some contact information for Melissa, Tamara, and myself. We are the team at TMA, and we're quick to respond to emails, or if you have to get in touch with us via phone, then please do so. We also encourage you to follow us on social media, LinkedIn, YouTube, where we're posting quite frequently. And if there are any questions about TMA, feel free to let me know. But I really just want to introduce our speakers for today. We have Jeff Cummings and James Wheeler. I'm going to read their bios quickly, but before I do that, just a couple administrative things. Since our group is small today, I'm recording at the moment, but once the more formal part of the presentation is over, I will stop recording, and then we encourage people to turn on their cameras and maybe unmute themselves if they have any questions, so we can have a dialogue that's a little bit more intimate to answer people's questions. So Jeff Cummings is a consulting CFO for SDX Advisors. He is a financial executive with experience as CFO, controller, corporate secretary, and COO in publicly traded and privately held companies, primarily specializing in manufacturing, wholesale distribution, drone delivery, medical device, and life sciences. Jeff holds a bachelor's and master's degree in finance from San Diego State University, earned his MBA with honors from University of Southern California, and was a finalist for the San Diego Business Journal's 2018 CFO of the Year Award. And we also have James Wheeler, who's a CFO at Narrative Financial Management, LLC. With over a decade of senior financial leadership experience in the service technology and consulting industries, James founded Narrative Financial Management in 2017 to serve the contract CFO needs of growing service and technology companies. As a fractional CFO, James provides clients with implementation and ongoing oversight of their accounting, treasury management, financial planning and analysis, and tax functions. After serving in the U.S. Navy's submarine service, James earned an MBA at the University of California, San Diego, where he held multiple fellowships. James has also completed analytics coursework at MIT Sloan through their executive education program. So James and Jeff will be tag teaming today's event, and without further ado, I'm going to hand the screen sharing capabilities to James.
Thank you, Shara. Shara, can you see my screen?
Yep, looks good.
Perfect. So, as Shara mentioned, I'm James Wheeler. I'll introduce myself a bit more in a moment, but we're going to get things kicked off with a good old-fashioned disclaimer. Please feel free to read along. The content and communication of this presentation were prepared for informational purposes only. Any such information or other materials, including responses to any audience questions, are not intended to be and should not be construed as legal, tax, investment, financial, or other advice. As previously disclosed, this presentation is being audio and video recorded and may be published in various media, including print, audio formats, without further notice. That was my best disclaimer voice. Although, as a CFO, I'm not sure I have any other voice, to be honest. My name is James Wheeler. I've operated a fractional CFO practice for the last 3 years. My last full-time CFO role was for the US-based subsidiaries of a $1.5 billion Australian company. As Shara mentioned, and you'll see here, I was formerly a member of the United States Navy Submarine Service. And my practice with narrative financial management provides implementation and ongoing oversight of the accounting, treasury management, tax, and FP&A functions for service and technology companies up to 20 million in annual revenue. Jeff?
Thank you very much, James. I founded SDX Advisors roughly 3 years ago, left my last corporate CFO role and decided to work for myself, which of course means, if I have issues with my boss, we know who that is. Have enjoyed the client and consulting, and we'll talk about today why people like James and I enjoy doing what we do. But I founded SDX Advisors as a business strategy and finance consulting firm for 2 purposes. First of all, similar to as you would go to your personal financial planner and map out and plan your financial future, SDX Advisors help plan and roadmap our clients' future, financial future. Along with that, instead of making decisions based on intuition and gut, SDX Advisors help business owners make data-driven decisions. So first, we're going to talk about what is the CFO and how has the role of CFO changed over the last 25 or so years. Second, we're going to discuss the role of the fractional CFO and what does that mean and how can that benefit your company. So we'll start there. So when we think about the traditional role of the CFO, we often think of certain stereotypes. Things that come to mind are the chief bean counter, the sales prevention officer, or my personal favorite, Dr. No, which I've actually heard used in a corporate setting. In my opinion, these stereotypes existed not necessarily because they were accurate, but because historically the CFO is laser focused on accounting and expense management. Today, the role of CFO has become much more focused on being a strategic partner. Along with the accounting and expense management duties, which will always be there, today's CFO looks to be a business advisor who can help you forecast and impact situations to your business, such as when is the right time to raise capital, how to help prepare the company to sell at a higher valuation, or maybe more current issues like, well, how does a global pandemic affect our business and our near-term future? Or how do the results either way of this November election mean to our business? So today's CFO looks to be part of crafting the company's go-forward mission and vision, and then he or she looks for ways to fund these initiatives, along with controlling expenses and the bottom line. So along with focus more on strategic initiatives, it's not uncommon to see today's CFO have other duties, including being in charge of operations. There's a role, the CFO/COO role, which is growing in popularity. And in fact, with one of my clients, I hold that role of CFO/COO role. So along with the accounting and finance duties, I'm also helping develop back office infrastructure, sales delivery models, and such. It's not uncommon to see today's CFO oversee non-finance departments like IT or HR. It's also not uncommon today to see the CFO step into a CEO role, which a generation ago was really unheard of. And today's CFO often gives up full-time role to be fractional consulting CFOs. So looking at our next slide, what type of CFO is right for you and your company? And sorry to answer it this way, but it depends. And I know nobody likes that answer, but it really depends on you and your company's needs. So a couple of situations we might look at advising you on this would be, are you a public or a private company? Because the skill set for a CFO for a public and private company are different. For a public company, you're probably going to want a CFO that's got their CPA license due to the technical accounting and compliance required for public companies. Now, if you're a private company, you don't necessarily need a CPA and don't need a CFO that's going to be that laser focused on compliance. You might need someone that's just a little bit more interested on financial planning and forecasting, along with building accounting infrastructure. So again, public or private might determine which type of CFO you bring in. Looking at internal versus external facing, what are the needs for your company? Do you want a CFO that's going to be in front of investors, pitching to investors, and maybe bringing in capital? Or do you want somebody that's a little bit more internal facing and is going to help build out your financial systems and processes and help with forecasting and planning? So again, the needs of the finance functions determines what for CFO you bring in. Industry nuances can also impact the CFO that you need. Does your industry have specific needs that you want your CFO to address? A couple of examples might be manufacturing, where you might want somebody that has bill of materials or bill of operations / labor understanding. Somebody that can understand manufacturing variances and set up an accounting and MRP system to track these. Maybe you're into government contracting. You want a CFO that understands the complexity of government contracting, government audit, managing SIBRs, etc. Maybe you live in an FDA regulated environment. You want a CFO that understands the specific needs of an FDA regulated environment, such as, facility planning, when you have to have a FDA certification to a certain address, or CFO that needs to understand lot traceability. So as you purchase materials, you need to be able to trace lots all the way back to the vendor. Are you a B2B, B2C, B2G company? Again, each one of these might determine the skill set of the CFO that you bring in. So it's not necessarily a deal killer not having that industry experience, but having a CFO that knows your industry can help you keep compliant, help plan for appropriate expenses, and help you craft the appropriate vision for your company. The stage of the company's life can also determine which CFO is right for you. Don't think that you have to have the same CFO throughout your company's life. And as James will show in a little bit, you can match the skill set and experience of your CFO to your company's needs in the current stage of your company's life. And then we look at full-time versus fractional CFOs. So questions you might ask is, do you need a full-time CFO right now? Can you afford a full-time CFO? And the big question, do you need to wait to have a CFO until you can afford a full-time CFO? And again, going to answer it with it depends. It really depends on what does your company need in the near future? So are you looking for investment? If you've got a 20 million Series C round come in, you're probably going to want a full-time CFO. Accounting records, get ready to or CFO. But if the answer is no to these, consider a fractional CFO to meet. So let's talk about the word fractional. To clarify, fractional is a buzzword, and the fractional model resources and effort, and I think that the fractional model is critical for helping grow companies, especially here in San Diego, where we tend to be an incubator for companies. We're really good at starting companies, we're really good at growing them to a certain level, but then often they sell and either the technology or the company leaves before they really get to the scale that they need a full-time CFO. And I think the fractional model fits really well. And finally, the part-time or fractional CFO, this is not a new model. This has existed for a number of years now. In fact, if you've been in town recently, you remember Tatum Partners were always the go-to for your CFO needs. But along with the recent rise of outsourced back office functions, there's been a corresponding rise in the recognition and acceptance of the fractional CFO, which I really believe benefits many companies because it brings CFO skill set and experience to companies that can't afford or don't need a full-time CFO. So in summary, a CFO doesn't have to be a long-term hire. A CFO doesn't have to be a full-time hire. You can find a CFO whose experience is tailored to your needs and nuances. So you have a choice. You can and should pick the CFO that's right for your needs as they exist now today. And so I'm going to give it to James, who's going to show us how a company's life cycle can determine the type of CFO that you need.
All right, thank you, Jeff. For anyone who's just joined in, I'm James Wheeler. I'm going to be walking us through some different things you might expect from a fractional CFO among the financial functional areas and also across different stages of a business. When the matrix on this slide is fully visible, it's going to be a lot of content, but I wanted to present it this way to give you all a sense of the breadth of subject matter expertise required to financially manage a business and the unique opportunity that fractional CFOs present early stage or smaller businesses to access truly valuable advice. When we talk about the functional areas, seen here on the left axis, we refer to accounting, tax, treasury management, and FP&A, where FP&A is financial planning and analysis. In a private company, you can think of these functional areas in order as keeping score, which is to say looking backwards, compliance, managing cash, and planning, which is to say looking forward. A fractional CFO will be able to inform action in each of these functional areas regardless of company stage. The company stages here are a bit contrived, by which I mean I made them up, mainly to accommodate this framework. As we take a look at each stage, I'll first describe the stage itself, and then I'll ask some questions a company will face and a fractional CFO can help answer for each functional area. Alternatively, there will be a few where I'll simply directly describe an approach that might be taken in that context. So we're covering a lot of material here. The point is a broad overview. Please raise any questions that may come up for you during the Q&A following this presentation. So here when we discuss pre or early revenue companies, we're talking about companies with little infrastructure and no material outside investment, but lots of problems with which a fractional CFO can advise. So questions companies at this stage may or should have might be, what are the future implications of our accounting ecosystem choices today? What are our tax compliance requirements today, and to whom should we turn to fulfill them? When will we run out of money, and what can we do to extend that time? And finally, with FP&A, does our business model make sense and warrant investment? As indicated by the outsourced bar below the table, it makes a lot of sense at this stage to leverage a fractional CFO to help answer these questions. In the investment stage, we're talking about companies who've taken outside capital. These companies should expect to have additional reporting requirements and the supporting people, processes, and technology to support those requirements, regardless of revenue level. Those of you who've received grants will understand the added overhead required to administer their compliance, for example. So questions a company may or should face here: how do we efficiently meet our investor expectations for reporting? What are the downstream impacts of tax-related decisions we're making today? Which banking relationships will serve us best? I like to note here that the threshold for access to the commercial side of the house at a Chase, Bank of America, or Wells Fargo is going to be in the $30 to $50 million range of annual sales. If you fall short of that and you're with one of those banks, you're going to be stuck on the retail side, which, as we can talk about in the Q&A section of the presentation, is not a fun place to be. How long will our money last, and how will we know if we're on track for subsequent success? The tools of FP&A can help answer those questions. Once again, there's overhead associated with managing investor relationships and complying with investor expectations or requirements. A fractional CFO is a great way to do this effectively while reducing the negative impact on your financial runway. Cash flow here refers to companies, whether or not they have outside capital, that are generating more money than they're spending. Once you're cash flow positive, there are specific needs a fractional CFO can address. What are the appropriate platforms, people, and processes to execute the accounting function now and as we scale? What are the appropriate tax mitigation strategies we should be exploring, and what's needed to support them? What are the appropriate treasury management products to support our growth? And finally, are we on track to our plan for profitability and scalability? Execution and financial discipline are nearly synonyms in this stage, and if you don't have the financial leadership available internally, outsourcing it to a fractional CFO can make sense for many, many companies in this stage. Fractional CFOs can be a crucial partner in the common event of a crisis. Jeff brought up the recent example of a global pandemic or a stall. When I say stall here, I'm referring to an unexpected or unexplained slowing of growth or reduction in profitability. You'll note we revisit the fundamentals of most functional areas in this case, sometimes because these issues were never previously addressed, sometimes because assumptions were wrong, and sometimes because the environment changed, whether competitive or economic or et cetera. The exception here might be treasury management. Cash is critical for buying time or other resources needed to navigate a crisis, and so you can expect a fractional CFO to help ensure you have maximum liquidity at minimum risk in this scenario. For most companies at each of these stages we've covered so far, it makes a lot of sense to leverage the experience, expertise, and accessibility of a fractional CFO, and so I would recommend outsourcing this role more often than not. The analysis becomes a bit more nuanced as companies scale and either exit or mature. Scaling or rapidly growing companies have ideally addressed all the issues up to this point, and the focus shifts to articulation of a 3 to 5 year plan, capitalization of the plan, and oversight of its execution. During this phase, a company may grow to the point or have sufficiently complex or specialized financial operations that it makes sense to hire a full-time CFO. At some point, a company may transition or aspire to sustained profitable operation or the sale of the company. Ideally, this objective was set in one of the earliest stages, as the decisions made then should have been made in support of one objective or another. And critically, the decisions may vary depending on the objective. As with the rapid growth phase, it may be appropriate to utilize a fractional CFO to assist with the diligence in the event of a sale or to oversee execution in the event of sustained operations. Questions may include, what's the appropriate capital structure for our context? What can we do to improve our valuation or our sustainable profitability? Or how do we navigate diligence efficiently and successfully? There are scenarios where it makes sense to bring in a fractional CFO with a specialized skill set to assist with this stage. even if you have a full-time CFO. Other times, you may have hired those skills on a full-time basis at some point with an eye toward successful execution of this stage. With that, we've covered a lot of ground here. I hope we've been able to illustrate, at least to a limited degree, the breadth of knowledge required to navigate the financial management of a business and the value of having access to this type of expertise, especially at a stage when capital is too limited to have a full-time CFO, or when it just makes sense to utilize the capabilities of a fractional. It's worth noting that no one is a master of all these functional areas in all industries. Two considerations are warranted in light of this fact. First, as Jeff pointed out, finding the right fractional CFO for you is important. And second, you should expect your fractional CFO to have a Rolodex of deep subject matter experts in these areas should the need arise. To summarize in a slightly different way, fractional CFOs can provide companies like yours with guidance for each stage of growth, leadership across financial functional areas, accessible advice, and diversity of style and experience. With that, I'll turn it back over to Jeff to lead us through some lessons from clients and key takeaways.
Thank you, James. We thought it'd be good to end, a lot of theory up to now, and as much as James and I love accounting and finance theory, maybe not everyone shares our passion for it. So we thought it'd be a really good idea just to talk about some lessons from clients and things that we've seen in our careers when we come into situations and maybe the companies didn't have good finance advice beforehand. So first one is lack of controls. So in your companies, you look at your company, ask questions, who's watching the cash transaction? Who has an eye on what's going in and out of the bank accounts? Who's looking at the purchasing transactions? Do you separate or segregate the people that set up vendors in the system from the people that cut the checks? So there are areas that are fraud areas. And again, this is where finance is critical to help keep an eye on these things and put tools in place and processes in place to put these controls in to protect your company's cash flows. And I can tell you personally that in my short, 3.5-year consulting career, I've come into 2 clients that had in the past experienced some type of fraud, some type of embezzlement. And again, it's good because people aren't keeping an eye and segregating duties. So again, having that finance advisor that can come in there and put these in place for you truly does protect your company's assets. Another issue that we see is what we call the mismatch accounting platform. So, 9 times out of 10, startups and younger companies go to QuickBooks for their accounting system, and it really is a great starting point for your record keeping. But what we see in our career is companies that stay in QuickBooks too long. As they grow in complexity, as they grow in size, eventually they outgrow QuickBooks. So who is advising you and your company on, first of all, when is it time to leave QuickBooks or whatever accounting platform that you have and invest in a more robust accounting platform that can scale with you? Another issue that we see is we see companies that are too loose with equity. So I know, especially at the startup level, sometimes equity and stock is really the only currency that you have. But what we've seen in our history, in our consulting careers, is companies that maybe give away too much equity. And I've seen times where people will give away equity to maybe somebody that develops the first website, or maybe somebody that does some type of engineering work early on in the company's life that by the time I've come in, that functionality has been changed due to change in vision or different markets to approach. And what we recommend is, again, equity is a long-term cash, right? Equity is a long-term investment. You really want to match equity grants with somebody that's going to provide value for the long term. So again, this is an area that a consulting CFO can help advise you on. Another area that we see with clients is not securing intellectual property. Often many hands go into bringing a product to market, and it's critical that companies get what I call put a fence around their IP. So who owns the IP? What, have we secured contracts or assignment of IP with everybody that might have a claim? on that IP, so that when we go to bring our products to market, that's all situated and settled, and nobody will try to make a claim afterwards. So again, look, who's it giving you advice on those matters? What we call is the wrong bookkeeper. So, common situation is you're setting up your company, you hire a CPA, and the CPA helps set up your chart of accounts, helps you get situated in your accounting system. Great job, definitely needed, but eventually you get to the point where you need to move the bookkeeping to somebody else. You don't want to keep paying your bookkeeper to manage the books when they're charging $150 an hour. We could recommend, bringing somebody in $40, $50 an hour, and at lower price point saves you money. So again, somebody to keep an eye on when is it time to utilize the CPA to do that, and when is the time to take that away from them and get the lower price point. Another issue we see is sloppy record keeping. First of all, in the generally accepted accounting principles or GAAP, GAAP is critical when you are going to face an IRS audit and they're going to audit your books, or you're going to sell your company, you're going to go into due diligence, and some corporate buyer is going to come in and look at your books, look at your record keeping. GAAP matters, and you want to make sure that somebody has oversight over the accounting and making sure that it's GAAP compliant. Also, accurate corporate record keeping is also critical. Is your stock register up to date? Are you holding shareholder meetings? Are you keeping the appropriate minutes? So again, these compliance areas matter, because one day you might want to sell your company and all of these records are going to be looked at. It's much easier to take care of these compliance matters when your company's younger, when you're starting out, when just things are simpler. So again, CFO can advise you and help you for key takeaways. And again, we definitely thank you for your time today. We can go to the next slide. Key takeaways is find a fractional CFO that meets your exact needs. You can match the CFO to your industry, to your company's life cycle, etc. GAAP matters. You need a CFO that can help get your books compliance, so that one day when you go into due diligence or have an IRS or maybe an accounting audit, your records will be set. Compliance matters. So again, making sure that all your records are complete and accurate, because you don't want to wait 4 years down the road and go back and try to do this. Be stingy with stock. Again, it's a great currency, but it's not something you want to give away without careful thought, consideration, and advice. So again, your cap table management matters. Tech ecosystem matters. So making sure that whatever accounting MRP system that you're using is right for you now, and knowing when it's time to pull the trigger and invest in something with different, more robust functionalities. So your CFO will be your business partner and trusted advisor, and should be a key person in helping you navigate through these issues. With that, we thank you for your time, and I'd love to open it up to questions.